Hey, and thanks for watching. And today I'm going to show you my real estate capital account tracking tool. Now, valuation tools get a lot of love on our website. Asset management tools, not so much. And so I thought I'd throw a little tool in here that I recently built. I'm not in asset management, so take this with a grain of salt. But I know that there's a need to track partners' capital accounts. I've done it professionally in different roles when I was on the residential side. And so having a tool that keeps you up to date on what's the balance of each partner's capital account, I think is helpful. And so that's what this tool hopes to get at. Now, typical partnership agreements I see call for some preferred return during operations, right? Call it 8%. And so the partners are paid 8% of the returns, and any excess cash flow goes towards paying down their capital account, right? But what generally happens is there's not enough cash flow thrown off from the property to even cover the preferred return. And so the difference accrues to each partner's capital account until there's some capital event at the end of the hold period, at which period the accrued preferred returns paid off, the capital account is paid to zero, and then the promote is paid out based on whatever waterfall structure agreement is in place. And so that's how this document or this tool works. So what we have up to 4 partners. You would drop in their names here. You would drop in their initial contribution, and then it's going to automatically calculate what proportion of the equity each partner has. Now this assumes that the distributions in this first level and the preferred return level are equal to their percent of equity. If it were different, what you would want to do is you would want to come and override these formulas to input what the distribution percentage is. And what you sometimes see is the sponsor might put some equity in but not get any preferred return during operation. So the sponsor might be getting some management fee, but isn't actually getting a preferred return on the equity that the sponsor has in. But in this case, this assumes what I think is the most typical case, where each of the partners is paid their pro rata share up to the preferred return, at which point their capital account is paid down, again pro rata, based on the cash flows that are coming in. So you drop in the initial contribution. Any additional contributions in the future, I'll show you in a minute how those are modeled in. And then you're going to put what preferred return each partner gets. And typically it is the same, right? In this case, I'm calling it 8%. But there may be scenarios where this is different. This then calculates the total contributions. So the initial contribution plus, and again I'll show you in a minute how you model in additional contributions, plus those additional contributions give you total contributions. This will give you total distributions, and you'll drop those in manually as those actually happen. And then this is the balance as of some date that you specify. Now the date right here, that's the account balance month, and it's defaulted to today, and that's most likely, right? You're going to open up this model at any given day and you want to know what's the balance today. But let's say that you're doing quarterly reporting and you want to say what was the balance at the end of last quarter. You would then change this date to give you the balance as of. Okay, the other date that's important is the initial contribution month. So you drop in this contribution amount. When was that? When did that happen? Or when did the joint venture start, and when did everyone initially fund their capital account? It doesn't mean there won't be additional contributions in the future. There probably will. But this is the date when the very first dollar came in. And then finally, this is the internal rate of return for each of the partners as of the date. Now, more than likely during operations, this is going to be NA, and it's set to be NA if the IRR either errors out or is less than 0. And that makes sense, right? You've put in more than you've gotten back, or there's more contributions than there are distributions, or certainly in this case, distributions is 0, and that's what happens during operation. But as soon as let's say you have some event, or maybe you have a property that's performing very well, and you might get to the point where the IRR starts to climb above 0 at that point in time. This will show here. Now finally, to drop in what happens in the real world, you have here these groups. and you can hide or unhide these groups, or collapse or uncollapse these groups. Either all of them at once up here, 2 collapses all, 1 hides all. Okay, or you can do them one by one. So let's say we want to just look at partner 1. So we click that plus sign, opens up partner 1, and here again, blue cells are input cells, black cells are output cells. And what you would input would be contribution. So this partnership began January 2014, and so we would come in here and we would drop any additional contributions that this partner has made to the partnership through whatever period that we want to put. And then we also do the same with distributions, and then that'll flow up to this. Then we have a similar thing for partners 2 through 4. And we're just going to, okay, these are actual, right? We're going to put in what were the actual contributions, what are the actual distributions that have been made, and then it will, again, the output, the most important output of this model is the balance, the capital account balance. So there you have it, my real estate capital account tracking tool. If you have any questions, please do reach out to me. Any comments, especially from those asset management professionals out there. This isn't an area that I'm as strong in, and so any feedback you have here would be greatly appreciated. And have a nice day.